Is Josh Reed from NYU, and this title looks like a finance-related talk. It is, but something tells me it's going to have a queuing model in it somewhere.
Yeah. It is.
Yeah. Josh Reed.
All right. Thank you, Mike, for the introduction, and thank you to the organizers for inviting me here to give this talk. The title of the talk is High-Frequency Asymptotics for the Limit Order book, and this is joint work with Peter Lackner, who's a colleague of mine at NYU, and with Sasha Stoikov. Sasha, Cornell University has a Masters of Finance program where they give it in downtown Manhattan, and Sasha is actually the director of research for that program, and he also spends one day a week working at Cantor Fitzgerald trading. So he's got quite a lot of familiarity with this type of stuff. Okay, so let me give you sort of the motivation for the talk. Try to do it really quickly. The story basically goes as follows. If you're an equity trader in the year 2013 and you want to place an order for a stock, you have lots of different options on where to place that order. Okay, there's lots of different exchanges that are out there that are all vying for traders' business. Okay, the exchanges operate for profit, and they all offer different types of incentives to get people to place their orders with them. Now, there was a study done in 2010 by Russell and Kim, which basically looked at all the different exchanges throughout the world. And essentially what they found, and I think this is probably something which people already knew, but kind of documented, that about half of all exchanges throughout the world operate according to what's called market-driven exchanges. Essentially, what a market-driven exchange is, and I'll talk a lot more about this throughout the talk, but these are exchanges that rely on something which is referred to as a limit order book in order to match buyers and sellers. Okay? And another important aspect of these market order-driven markets is that many of them tend to be electronic. Okay? And the way that they work is it's not kind of the old-fashioned system where everybody is yelling and shouting on a stock floor and people are physically trying to match orders up. What happens is you submit your orders to these exchanges through a computer, and the computer actually, there's algorithms which actually determine how to match up buyers and sellers. So everything's being done electronically, and one of the effects of that is that there's potentially thousands of trades occurring every second for a particular security on a particular exchange. And so these exchanges operate in what's sometimes referred to as a high-frequency regime. Okay, and so that plays a very important role in real life, plays an important role in terms of how do you decide how much to trade, and there's algorithms at all these hedge funds that are trying to figure out when to place trades of what size, and everything's happening on a very fast time scale. And it's also very helpful to me or to us if we want to analyze these types of markets because it allows us to use asymptotic sorts of results like the central limit theorem and the strong law of large numbers, et cetera, because we have lots of things occurring every second.
Question?
Yeah.
What's an example of a market that's not order-driven?
Think about the New York Stock Exchange 10 years ago. Okay, you have people yelling and screaming on the floor, or the Chicago Board of Trade, maybe something like that. Okay, so let me give you a little bit more detail of how this limit order book thing works. Okay, this is sort of the quick story about that. Essentially what happens is the following. You come to one of these exchanges and you want to buy or you want to sell a stock. And what happens is that you have two different options on how to do that. You can either choose to place what's called a limit order, or you can choose to place what's called a market order. Okay? And they operate very differently. Okay? Limit orders work the following way. If I want to place a limit order to sell, what happens is I come to the market, I look to see whatever the price of the stock is that I want to sell, and then I say, okay, I want to sell stock XYZ but I don't want to sell it at the price listed right now. I want to sell at some higher price. Okay? So you submit your order to the market. The market holds on to your order. It records it in a quote-unquote book. And then if the price of the stock reaches the level that you want to sell at, your order gets executed. If the price of the stock never reaches that level, so if by the end of the day, let's say the stock price goes down as soon as you place your order, so it never reaches the level you want it to sell at, then what happens is your order just gets canceled basically at the end of the day.
And is the day really the time unit for expiration?
I think that at the end of the trading session, it will get canceled. You also have options to prematurely cancel if you want to as well. So you can call the exchange after a few minutes and say, get rid of my order. But then you get charged fees typically for doing that. They don't want people doing that. Yeah.
What is the definition of price of stock?
Okay, that's a very good question. So what's the definition of the price? So the price in this type of market, there is no price. There's something called a spread. And the spread it'll become more clear actually when I show the model, but the spread is the difference between the lowest limit sell order and the highest limit buy order. And that's called the spread. Okay. So there actually is no price.
Of course, it's price interval.
There's a price interval if you want, yeah. You'll see exactly what's going to happen in a second. So, okay, so that's what a limit order is. Now, you can also place limit orders to buy. They operate the same way, really just flipped. You place a limit order to buy, you just give some number below the current price of the stock. You say, I want to buy something cheaper, and if the stock gets down to that price, the limit buy order gets executed. Okay, so that's limit orders. Now, the other thing you can do is you can place a market order. Market orders are for people who are less patient. Market orders get executed immediately. So you come to the stock, the market, you say, I want to buy the stock, and they say, here you go, you have it, you walk away. You take it at whatever price it is right now. You don't get to choose. Okay, so that's called a market order. So that's the way things work. If you can think about it also sort of in a more abstract sense, in that limit orders are really what's providing the liquidity to these markets, and market orders are what are removing the liquidity from the market. Okay? You can,
So how many are market orders? How much are limit orders?
how much?
What fraction of orders are limit orders? What fraction are?
They have to be roughly the same because what ends up a market buy order, you'll see in the model too, but a market buy order gets matched with a limit sell order. Okay, so and a market sell order gets matched with the limit buy order. They annihilate each other. So
there are many limit orders which don't get which don't.
okay, yeah. So right. So there's also actually it turns out correct. So it so it actually turns out that a majority of limit orders actually end up getting canceled by the end of the day. And so I don't know actually the exact fractions, but in this model they're going to be roughly the same. The arrival rates of them will be roughly the same. Okay. So here's the picture you can have in your mind for the rest of the talk of what's going on here. The red, each green box represents a limit sell order which has not yet been executed. So at any point in time, if you look at a stock, there's going to be a whole bunch of limit sell orders and a whole bunch of limit buy orders that are waiting to be executed. And so that, if you drew a picture of that, it would look something like this. Each green box represents a limit sell order. Each red box represents a limit buy order. And the location of the box is meant to represent the price associated with that order. Okay? So this right here, the totality of all these orders is what we call the limit order book. Okay? It's as simple as that. And you might be wondering why are the green boxes going up and why are the red boxes going down? And the reason for that is that if you draw this in black and white, and if everything was facing up, you wouldn't know where the limit sell orders stop and the limit buy orders begin, right? But we have color here. It's not that much of a problem, but okay. Okay, so that's the limit order book, and really the idea behind this talk, I guess, and not just this talk, but I think the idea behind a lot of the literature in this area is that the order book is operating on the order of milliseconds. Okay. Thousands and thousands of trades every second are occurring. So this limit order book is moving along very quickly, order by order. It's the most discrete thing you can have when it comes to the evolution of the stock, right? That's it. It doesn't get any more, discrete than that. There's a limit order book. That's where everything kind of ends in some sense. And so the idea is that people want to study this limit order book and try to see if by understanding the behavior of the limit order book very well, you can work your way back up to predicting the movement of the stock price over larger timescales. Right? It's a typical type of thing. We think about it in probability, right? And so, of course, it's going to matter the exact rules governing the behavior of this thing. Those are going to affect what we see at larger timescales. Okay, and so this whole area of finance, which studies the limit order book, is sometimes referred to as market microstructure. Okay, because people are trying to understand what they call the microstructure of these markets. Okay, and so that's basically what I'm going to do today. Okay, okay. So there's a lot of literature in this area, like I mentioned. I'm constantly more papers are coming out. These papers right here serve to give you a little bit of an idea of different types of people that are working in the area and things which are kind of related to what I'm going to show you. I think that one of the interesting things and nice things from my point of view is that a lot of the work in this area now is focused on using tools from applied probability. So people are, like Mike mentioned, using queuing theory to try to analyze this order book. Okay, because there's a lot of carryover of tools from queuing theory that you can use to analyze the order book.
Multi-dimensional here.
Multi-dimensional, right here? What is
here, multi-dimensional?
What is here multi-dimensional?
By now it's only one dimension, yeah.
Okay, good. So what is multi-dimensional? One type of model. So there's no real accepted model of the limit order book. It's not like a GG1Q and we just go and analyze. Right? No one settled on a particular model. So what some people do is they say, I'm going to create a dimension for each price level. And I'm going to keep track of how many orders are at each price level. And that's going to give rise to some multi-dimensional Markov chain. Okay, so that's one typical approach.
In practice, this goal is a lot more complicated, right? You have all or nothing orders, you have stop loss orders. So what's happening to all that?
Yeah, okay, yeah, good. Okay, in real life, of course, it's much more complicated. We're just getting rid of all that complication.
You're not going to deal with that.
No, I'm not going to deal with any of that. No.
You're not getting rid of all the complications.
I'm getting rid of enough of it to keep things interesting, but somewhat amenable to analysis. Yeah.
Just one question.
Who's that?
Can you comment on what type of information is available?
Okay. So what type of information is available if you're a trader? So if you're a trader, it turns out you can actually pay an exchange. So you pay the exchange to get information. And you can get what's called level 1 quotes, level 2 quotes, level 3 quotes. Each type of quote costs more money to get, and it gives you information deeper and deeper into the book. Okay? So you can find out how many orders are just at what's called the top of the book. That would be this guy and these two guys. You can find out how many orders are a little bit deeper in, and so on and so forth. Okay? In real life, what a lot of exchanges do as well, is that they recreate the book on their own. Okay? So in real time,
It works perfectly well when you keep your head up.
Can you hear it?
Yeah.
Okay. So in real time, what a lot of firms will do is they'll see where orders are being placed, and they'll actually in-house create what the book is in real time for themselves. Okay. So that's another thing which can happen. Okay. So anyhow, there's a lot of literature on the subject, and it's a really fun area to work in. Okay. So here's the model that I'm going to use for the rest of the talk. So essentially, I'm going to get rid of one side of the book. So I'm not going to look at the buy side. I'm just going to focus on the sell side for convenience. Okay, it's going to make things easier for us. And so things look like this. So I only have limit sell orders, and the price is going to be defined to be the price associated with the smallest order on the book. So this green box right here, this guy wants to sell for the cheapest of everybody that's placed an order, and so he has defined the price. Now, mathematically, the way that you can think about this, mathematically, the way you can think about this is that the book is like a measure. Okay? I want to think of the book as a measure. Okay? So at each point in time t, the state of the book is represented by some finite counting measure, mu of t. And how is this measure defined? Well, for every Borel set, right, the measure of that set tells me how many orders in the book have prices which lie in that set. Okay? And that gives you a full description of the book. And in fact, you can recover the price from that as well. Right? The price just ends up being the lower limit of the support of this measure. Okay? So I'm going to show you a bunch of pictures right now about how the book evolves. But in the back of your mind, what you should be thinking is that there's this measure which is going to be evolving over time according to certain rules. Okay? But it's easier to show the pictures than it is to put up a bunch of notation. Okay? So here's essentially what happens. Market orders are going to start, there's some book at time 0. So at time 0, I start off with a measure. That measure represents the book at time 0. Then market orders start arriving to the book. And they arrive to the book according to a Poisson process with rate lambda m. Okay? Now, every time a market order arrives, it picks the lowest order on the book and it takes it off of the book. Okay? So these are market orders to buy. They're arriving. These are limit orders to sell. So the market order to buy arrives. It finds the lowest limit order to sell, and it yanks it off of the book. Trade is executed. Okay? So here's an example of that happening. I have my book right here. A market order arrives. This box right here was the lowest order. It's gone. Okay? It gets taken away. And when that happens in this situation, because that was the only order here, the price now jumps up and it moves up to whatever level these guys have placed their orders at. Okay? Jose?
It seems from your picture that the quantity purchased happens to be the two quantities are matching.
Yeah, exactly.
This is fishy.
Right. Okay. Yes. So again, we're taking the simplest model we can have. So everybody places an order of size 1 to sell, and everybody places an order of size 1 to buy.
What does it mean? I mean, the left end of the axis. Clearly doesn't mean price 0 in practice, right? What does it mean?
This is some price. Like this could be $3.
Yeah, but the support of the measure is in the interval 0 to x.
Yes.
So the left end, the 0, it presumably means
it's not. It can never reach 0.
it would be like
It cannot. None of these guys are allowed to be at 0. There's no.
yeah, but you can get arbitrarily close to 0, I suppose.
You can get in the model. You'll see the model will never be able to get down to. In the model, an order will never be able to be placed at 0, but it can get arbitrarily close.
But because I asked because the typical types of models are the price really means relative price. So it's you compute the mid price, so the middle of the spread, and when you talk about price, you really mean number of units relative to the mid price.
So all right. So
how are you considering this?
there's no notion of spread in this model because we don't have a buy side to compare ourselves to. So we're interested in the movement of the actual price. We're going to be interested in the movement of the actual price, and not in the movement of the spread. Okay. Okay, so that's how market orders work. The other thing I should mention is that if there were two orders stacked up over here on the left-hand side and a market buy order arrived, it would take one of them. It doesn't matter which one for the purposes of the model. We just remove one of them. The other one would remain, and the price wouldn't change. Okay, so the price only changes when a market buy order arrives, and there's a single order at that level.
Can you show us the equation for the price? You had something different.
Okay, so
The equation for the price, the previous slide.
for the yes.
Okay. All right.
Biggest X such that there's no orders to the left of it.
Yeah.
What's that?
It says
Yeah, exactly. It's the left limit. Okay. Okay. Now, here's what happens when a limit cell order arrives to the model. So limit cell orders arrive according to a Poisson process with rate lambda L. Now, when a limit cell order arrives, it needs to figure out what price it wants to sell at. And so the way it determines that in our model is it looks at the current price, and then it takes that price and it multiplies it by some random variable x. X has some distribution f, and all the x's are IID from order to order. Okay. So what are the implications of that? Well, if x is greater than 1, that means the person is going to want to sell at a price higher than the current price, right? He's taking the price and multiplying it by. So here's an example of that occurring, and somebody arrives, they look at the price, and the purple order is the limit sell order that they've placed. So in this situation, the price didn't change. Okay? If somebody arrives and they decide they want to sell at a cheaper price than the current price, that would be x less than 1, then they jump ahead to the head of the line, and now they have the distinction of being representing the best price. And now the price decreases. Okay? So in summary, market buy orders arrive, the price either goes up or doesn't move. When limit sell orders arrive, the price either goes down or doesn't change. Okay? So that's essentially the way the model works. The only other thing I need to specify is you might ask yourself, what happens if a lot of market buy orders arrive really quickly and they take all the orders off of the book and now the book is totally empty? The answer to that is it's not allowed to happen. And the way that we deal with that is we create this person that we call the market maker. And the market maker sets some level A, where A is some integer greater than 0. And if the total number of orders on the book equals A, and a market buy order arrives and tries to take an order off of the book so that the number of orders drops to A minus 1, the market maker grabs into his bag of stocks and he wham, puts an order back onto the book exactly where that order was taken away from. And so the book doesn't change essentially in that situation. Yeah.
It seems that your multiplying by x model is implicitly assuming that the top of the buy order book is at 0, because intuitively what you would do is to look at the spread and you would try to multiply the spread between the buy and the ask to decide where to set your limit price, right?
Well, it could be like you're arriving and you see the price of the stock and you say, I think this company is worth twice as much.
Very unlikely that
So
they would behave like that. I think they would behave based on the spread between the buy and the ask.
There, potentially. People behave in all sorts of crazy ways.
The possible prices discrete?
Is it?
The set of possible prices discrete.
Okay, yeah. So on like most exchanges, like there's something called a tick, right? And the tick is the minimum increment of the price. So the prices all lie in a lot. And here they're allowed to just be anywhere.
Right.
So, but I understand that. That's clear. But in your picture, we see cubes stacked on top of each other. Now, why would you get 3 orders for the exact same price? Because it was a batch arrival?
Well, the random variable x could be discrete. And so you could have a few market orders come in a row and have the same value of x. A few sell orders come in at the same time, and they would all stack on top of each other.
But in general, the most common situation would be lots of ones spread out over barely differentiated prices. I mean,
the common situation is lots of orders stacked up on top of each other at prices very, very close to the current price.
okay.
Yeah.
But the answer to the last question was no, you do not discretize the price line.
No. We could, if we had like an additive model and we made x a discrete integer value, then everything. Okay, so I'm going till 3:30, Mike? Mike, 3:30, right? Or what time? Because we started late. So
320 plus your Sean allowance.
okay,
That's
320
plus
325.
grace.
Okay, so I shouldn't need to move quickly. Okay, so this exact model was studied by Florian Samatos, and he basically asked the question of what's going to happen to the price in this model. Is the price going to go to infinity? Is the price going to go to 0? It's a very non-trivial answer, okay, in this particular model. And essentially what he did was he showed that you can take the model, couple it with a branching random walk, and then you can use results from the theory of branching random walks to determine the direction that the price is going to move in. And the conditions are they're intuitive, but they're not easy to obtain, and they're necessary and sufficient. Okay, so that's some really nice work describing the model. Now, the thing that I'm interested in is these high-frequency asymptotics. And so let me describe to you the exact regime I'm going to consider, and then I'll give you guys the main results. So we have this thing that we call the high frequency regime. It has two components to it. The first component tells you how fast orders are coming in the regime. The second component tells you where people are placing their orders. So let me first tell you how fast they're coming in. This part is essentially the same thing as conventional heavy traffic for a single server queue. Okay? In fact, the total number of orders on the book is behaving just like a birth-death process, with arrival rates equal to the arrival rate of limit orders and death rates equal to the arrival rate of market orders. So the first part of the high frequency regime, what we do is we consider a sequence of order books, which we index by n, and essentially the arrival rate of limit orders and market orders in this regime is something like lambda times n. Okay? Lambda mn is the arrival rate of market orders. Lambda ln is the arrival rate of limit orders in the n system. We divide both by n and we get some constant lambda. So up to order n, market orders and limit orders are coming in at the same rate. There's no abandonment or anything like that. So they're coming in at approximately the same rate. However, they're differing by some square root of n amount, and that's captured by this quantity beta. Okay? And the sign of beta ends up playing an important role in the end. If we have time, we can get to that. The market maker also places orders at about, the level of the market maker changes as well in this regime as n gets larger. And basically the market maker requires the total number of orders on the book to be at around a tilde times square root of n in the n system. Okay? Jose?
So what's your sense of, like in practice, I have, isn't it true that the amount of limit order is a lot higher than the...
Yeah, because there's a lot of cancellations of them.
Yes.
Yeah, so here it's not being taken into account of. At the end, I can tell you what to do if you want to add abandonment into the model. Yeah.
So your limit orders are only removed by market orders, not because the price changes.
No, yes, only market orders. Okay, so the other component of the regime is where do people place their orders. Okay, and what happens essentially is that as the frequency of orders coming in gets larger, people start placing their orders closer and closer to the best price. And this is something which is empirically true as well. Okay? And so the way that we capture that is that in the nth system, somebody arrives, they look at the price, and they multiply that not by x anymore, but by x raised to this power of 1 over square root of n. Okay? And n is getting really, really large, so 1 over square root of n is going to 0, so x to the 1 over square root of n is approximately 1. So people are basically placing their orders right around the current price. And right, if you do a Taylor expansion of x to the 1 over square root of n, it's basically like 1 plus the natural log of x over square root of n. So that's telling you where people are placing their orders. Okay. So here's the first main result. The first thing that we look at is we look at the price process. Okay, so we want to know what's the price process going to look like in the high frequency, in this regime. Okay. So the answer is the following. So it turns out that if you assume some initial conditions, which let me not get into them right now, but under appropriate initial conditions and under appropriate sort of convergence of these initial conditions, and assuming that the expected value of the natural log of x is greater than or equal to 0, then in this case, the price process will weakly converge as a process. There's no scaling needed at all. So we don't have to scale time. We don't have to scale the price or anything. You just look at the price process. It'll weakly converge. And it'll weakly converge to this guy right here. Basically, what I have is I have my initial price at time 0, and that gets multiplied by some exponential. And the exponential is raised inside. I'm integrating from 0 to t, some constant divided by this s tilde process. And S tilde is a reflected Brownian motion. Okay, and it's being reflected at the market maker level of A tilde, and it has a drift of beta and an infinitesimal variance of 2 lambda. Okay. So let me try to explain a little bit about what this means intuitively. Okay, so first off, we have to have the expected value of the natural log of x be greater than or equal to 0. I can talk maybe later at the end about the case of the expected value of the natural log being less than 0. But if it's greater than 0, this is, of course, a positive quantity. And so the price ends up being a strictly increasing process in the limit. Okay? Now, the rate of increase of the price is modulated by this S tilde. S tilde is a reflected Brownian motion, being reflected at the level A tilde. It turns out, and we'll see this 2 slides from now, that S tilde actually represents the total number of orders on the book. So what's going on here is that as there's more and more orders on the book, it becomes harder and harder for the price to increase. Okay, and this is something which has been, empirically observed a million times over in the literature, and there's a name for that. It's called price resistance. Okay? Essentially what's going on is the more orders you have stacked on the book, the harder and harder it is for the market orders to take them away and push up the price higher. Okay? And vice versa, right? The less number of orders there are, the easier it is for the market orders to eat through those orders and push the price to higher levels or to lower levels. Okay? So that's our first main result. The second result is to look at the measure-valued order book process itself and see if we can get convergence of this entire process, this entire measure-valued process. Okay? So the way that we do that is we have to scale the measure-valued order book. So we call the scaled measure-valued order book mu tilde of n. And the way that the scaling works is very simple. You don't scale time. We don't scale sort of the price dimension of the measure. The only thing we scale is the total mass of the measure. Okay? And it gets scaled by 1 over square root of n. Okay? So if you let that be mu tilde n.
When you say scale total mass, but you started off by hypothesizing that arrival rates are accelerating like a factor n.
Right.
Didn't you?
Yeah, and the arrival rates are...
Right, so the volume of stuff coming in is growing like n, and you're scaling the quantities by square root of it.
Exactly, yeah. And sort of the row is going to 1 of this thing. So, okay, so if you take this diffusion scaled measure valued order book, same sort of conditions as in the previous previous theorem, then you get that this measure valued process weakly converges as well. And it actually converges to something which is relatively simple. It's a measure which has all of its mass concentrated at a single point. That point is the price, and that's basically what the limiting measure is. Okay. Now, I should mention that this is only true under the initial conditions that we assume in this theorem. And essentially what the initial conditions are saying are that at time 0, we're assuming that all of the orders in the book are basically stacked up on top of each other at the best price. So at time 0, they're all stacked up on top of each other at the best price. And if you start out that way, you stay that way the whole time. But of course, the price moves around, but everything stays stacked at the best price. Okay? And, at the end, we can see what happens under more general initial conditions. But I'm going to leave it at this for now. Okay, so so here's a little picture of kind of what's going on. If you were to look at the number of orders on the book and the price and put these 2 graphs on top of each other, and basically what's going on is the more orders there are in the book, the smaller the slope of the price, okay, and vice versa. Now the interesting thing about looking at these pictures is that this dashed line represents the market maker level, right? And if you let the market maker level get lower and lower, then the number of orders on the book can get smaller and smaller, and the rate of increase of the price gets larger and larger, right? And actually, if you take away the market maker completely so that the book is allowed to entirely empty at some points in time, then the price will blow up to infinity in a finite amount of time. This integral of 1 over this reflected Brownian motion will blow up to infinity as the number of orders goes down to 0. So the market maker is playing a very critical role in this model in terms of regulating the rate of increase of the price, or you can also think about it maybe the volatility of the price. Okay, he's ensuring that there's liquidity in order to make sure that the price doesn't become too unstable. Okay, so last part of the talk. So we have these limit theorems, and now the question is, well, can you do anything with them? And so the answer is, yeah, kind of. So so we do 2 things. We look at a transient analysis. Yeah.
The fact that it converges to a measure that is degenerated means that you probably want to scale the price dimension as well.
Yeah, okay, that's a very good question. Yeah, so exactly. So that's sort of our the next step, let's say, right? So yeah, you know, what's going on around that price? But it's a very hard thing to look at, apparently. Okay. So okay. So next thing is we look at do a transient analysis, and then we also do a long run analysis of the price, or of the entire order book. So transient analysis, in the paper, we look at a few different things. We try to calculate what's going to be the expected value of the price at some point in time, the limiting price process, what's going to be the expected total value of the book. We throw in all sorts of like fun things to look at. Expected discounted amount of money the market maker must outlay, blah, blah. Okay. So let me just show you how to calculate one of these quantities, because they're all somewhat similar to each other. Let's suppose you want to calculate the expected value of the price at some point in time. So essentially, the situation that you're confronted with is that you want to calculate this expected value right here. Right? I just take my limiting price process from the first theorem. I try to calculate the expected value. So I want to calculate the expected value of some integral of a constant divided by this reflected Brownian motion. Okay? Now, if the reflected Brownian motion is driftless, so if beta is equal to 0, then this reflected Brownian motion is essentially equal to the absolute value of an ordinary Brownian motion plus the market maker level A tilde. And you can just right away, like a hammer, just apply the Feynman-Kac formula, and that gives you a partial differential equation that will tell you this expected value. The solution will give you this expected value. In the case where beta is not equal to 0, it's not so neat. Okay, you can't just go ahead and do that right away. You need to take into account this, this term at the boundary. And so essentially what you do is you just go into the Feynman-Kac formula, you play around with it, the proof of it, and out comes this partial differential equation. Okay? So the solution to this PDE gives you the expected value of the price at each point in time, conditional on whatever your initial conditions are. And essentially, it looks like the Feynman-Kac formula, except there's an extra boundary condition which is being thrown into the PDE. Now, I don't know. It's possible that you can solve this. I'm not an expert in PDEs, nor apparently my co-authors. But we kind of leave it at this in the paper. And these other quantities all have a similar flavor to them in terms of calculating them. Okay, so last part of the talk is what's going to happen to the price if the limiting price process in the long run. So it turns out that the long run behavior of the price depends critically on whether more limit orders are coming in than market orders, or more market orders are coming in than limit orders. If more limit orders are coming in than market orders, then the number of orders on the book is going to blow up, and the price is going to have a hard time moving upwards, right? And if more market orders are coming in, then it's going to have an easier time. Okay? So we break out into these cases of beta greater than 0, less than 0, and equal to 0 being extremely difficult to handle. But in the case where beta is greater than 0, limit orders are coming in faster than market orders. And so the price is essentially, in the case of beta greater than 0, limit orders are coming in faster than market orders. And so in this case, the price is basically going to grow polynomially in time. Okay? And this is the exact result, right? So essentially what this is saying is that the price looks something at time t is growing like t raised to this power. Lambda times the expected value of the natural log of x divided by beta. Now, we can also identify the constant in front of this little big O term. And it's actually not a constant, it's a random variable. And it looks something like this. Okay, it's random, but okay. If beta is less than 0, market orders are coming in faster than limit orders, in which case the total number of orders on the book is going to be essentially positive recurrent. So it's always going to keep coming back down to this market maker level. And in fact, this reflected Brownian motion will weakly converge to an exponential random variable plus the market maker level. So if I define this exponential integral function, then it turns out that here's the asymptotic of the price when beta is less than 0. Essentially, it's growing exponentially fast. So it's growing much, much faster than when beta was greater than 0, and the constant looks something like this. So it's like e to this power times t. Okay. And if you want to, you can play around with this and with this exponential integral function, and you can get better asymptotics on the effect of the market maker. Okay, so that's pretty much the results that I have. Bunch of stuff on the slide. What to do if there's abandonment. You can replace RBM with an ROU, reflected Ornstein-Uhlenbeck process. As a lot of people have mentioned, the cancellations are an important thing to also take into consideration. We can maybe deal with trades of random sizes if we want to, but with finite variance. Infinite variance case is harder. And one last thing, I guess, which I wanted to mention is if the initial conditions are not what I said, or even if the expected value of this natural log of x is not greater than 0, there's actually a measure-valued stochastic differential equation which describes the limiting order book. And what I showed you was the solution to this measure-valued stochastic differential equation, which can be obtained under nice initial conditions. More generally, this is what the type of thing that you get, and you have to work with this. So, okay, that's it. So thank you.
Yes, Kumar.
So you postulate a model and you analyze it. Are there any parameters or anything that you can use this to fit actual behavior? I mean, how do we know that this is the way it works?
Yeah, right. Okay. Yeah. So we basically have two parameters that deal with lambda and the expected value of this natural log of x. Right. So presumably, I mean, we haven't tried to fit it to empirical to data, but those are the only two parameters.
So isn't it true that a tilde is a parameter?
And a tilde. Okay.
And then the second, so there's lambda, there's a tilde, and then there's the expected log of the multiplier.
Yes.
Right?
Yes.
3 parameters.
3. Yeah.
And so let me insert a question there. When you first put it up, I thought there was a multiplier x for each new arriving
X. There is. Each one gets its own x.
I see. So that, for some reason, it's only the expected value of that distribution that comes into play.
Yeah, we have ideas of how to, kind of along the lines of this, of how to rescale in order to get a second order term from the x to come into play as well. But that's
So so presumably there's data. Can you show what the data tell? I mean, does it conform with this, or?
we haven't taken right now. We're more focused on handling the case of expected value less than 0, and also of combining a buy and sell book together. And then at that point, I think we'll take it and try to see what's going on.
Let me put in another one. You cited the paper that had done the analysis of this model before you started on this limit regime.
Yes, sir.
In what kind of journal was that published? Economic Statistics?
It's a preprint right now, so it's not.
Where is it intended to be published? You don't know?
You have to ask. I don't know. I don't know where it's.
More questions? Yes.
So for me, at least for me, it's easier to think of your process actually as a point process. Because if your distribution you multiply with it's continuously with the density, then the point that you insert will be actually different from all the others. Okay, so you may think of your measure as actually a point configuration, which bears every unit of the stock or whatever at this particular price. So if you instead change your model in a logical way that actually your limit orders have, for instance, exponential time to live.
Right.
In this case, so basically the number of orders in the book will be Poisson distributed in the limit because it's just purely birth and death process. On the other hand,
all right, so there's also going to be no more market orders coming in. If market orders,
also market orders. The only thing
then
that you have is that.
I don't think it would be. It wouldn't be like an infinite server queue. Because the market orders are coming in as well.
Okay, if you just count the number of points there,
okay,
they are added with intensity lambda L plus lambda M. Mm-hmm. They're removed with the density.
No, they're not. They're taking
plus whatever leave time.
they're added with rate lambda L, but they're taken away with rate lambda M.
Yeah, there's another thing that comes is
The market maker.
Well, yeah, the time to live, right? The intensity which they just measure and removed naturally. Okay, so in this case, the number of points will be Poisson distributed, but the position will be something different. So I was wondering, so if this somehow being considered and
The position?
kind of model. Yeah, so it's actually, I think you would converge, I would bet you would converge to Poisson process actually. What's the distribution of the
I see.
I don't know. It should be dependent, of course, on your psi, or whatever you call it. It's F, distributed random variable X, yeah.
Sergey, there is a PhD thesis by a former student of Frank Kelly, Irina Yudovina, and she studied related problems.
I can say that in real life, the distribution of the orders on the book it is essentially power law coming off of the best price. So it tapers off very quickly.
Well,
Almost all the orders are at the price, and then they very quickly die off.
fine. So this is parameter measure of the Poisson process. That's what I'm saying. It's not homogeneous Poisson process.
Okay.
Non-homogeneous.
Okay. I think before we break, it might be, I don't know if this question is asked to anybody else, something about how we dress for dinner tonight. So is this such a place?